Budget 2021 tax structure and what should an HR know? Yeah. Now, all of you know that on 1st of Feb, the new budget was presented, and there were some new tax structure which was proposed. Today, as we go ahead in the webinar, uh, we would be we would be starting with creating a generic understanding about income tax. Uh, we would then talk about income tax structures that are there in India and what has been proposed. We will take up examples and calculations for your better understanding. And then briefly, I will talk about CHRMP, which is Certified Human Resource Management Professional. Right now, please note that CHRMP, which is Certified Human Resource Management Professional, is a premier HR certification. This is available to you with our certification partner Pearson View. This certification can be taken in 190 countries across 5,600 centers. And as we move ahead on this, we would also have some special offers for people who would be interested in taking up this certification with some discount vouchers, etc. Right? So just to begin, let's quickly start by understanding what is income tax. Now, when we say income tax, I think first let's understand the types of taxes that exist in India. I think there are two types of taxes that exist in India. You have direct taxes and indirect taxes, right? Now, what are direct taxes? Direct taxes are taxes which are applied directly or paid directly by individuals or companies, right? For example, income tax is tax, right? For example, wealth tax or a gift tax is a direct tax, right? This is directly paid to the government with involvement or without involvement of any intermediary source, right? You also have indirect taxes. Indirect taxes like GST, sales tax, sometimes back there was VAT or service tax, customs and duties. These are all taxes which are indirectly paid by the taxpayer, by a person or an entity, and it's called indirect taxes, right? I would not take too much time explaining basics of income tax. I just want to move so that we have a generic understanding of all these concepts and components, so that as we move ahead, we can elaborate on the current tax structure and what an HR should choose. But as it is HR and being a professional in human resource, a lot of times our understanding of finance is not that great. So we have chosen a very brief description of creating a base of our understanding of taxes, right? So there are direct taxes and indirect tax. So what kind of tax income tax is? Income tax is a direct tax. It's a direct tax, right? Which is very, very important for us to understand. Now, also one very interesting fact is that when you go to the income tax website, you will see that there are about 23 chapters and there are about 298 sections which talks about various aspects of taxation in India. Briefly, what it does is that, I mean, it's quite elaborate, but briefly it includes levy, collection, administration, and recovery of income tax. Different sections talk about all these. What is important for HRs to know is the tax structure, tax slabs, and also the exemptions that can be claimed by individuals for reducing the tax burden or net tax liability. That is, those aspects are really, really important. But in general, all this is in public domain, and this information can be seen in terms of what the 23 chapters and 298 sections explain the income tax structure in India. Now, coming to collection of income taxes, I think we all have heard of the term TDS, right? TDS is tax deductible at source. So most of the time when companies are paying salaries, they are deducting tax at source. There is also something called TCS, which is tax collected at source. And then there is voluntary payment by taxpayers into designated banks. Now this mostly happens in case of advanced taxes or self-assessment tax. People who are quite definite. So for example, if there is a celebrity or a film star or a sports person or individual earning high income, he is quite sure of an X amount of income that he would he foresees himself or herself earning, and then they go about paying advance tax or self-assessment tax. That is something that voluntary tax payment. TCS is just opposite of TDS. Normally in TDS, what happens is whatever income you have, on calculation, a certain amount of tax is deducted, and then your earning minus tax, remaining amount is paid to you. However, in tax collected at source, if let's say somebody is getting 10,000 rupees in TDS, if let's say 100 rupees is deducted, then you get 900 rupees. However, in tax collected at source, you don't touch the principal, which means 10,000 remains as 10,000, and 100 rupees, which is additional, is paid over and above, which makes the net output which is going is 1100. So it's just opposite. So you normally some people might not want to take the tax liability and they want the income to remain the same. In that case, they would go for tax collected at source, where the income tax is added and that amount is paid through, right? And that is what is called as tax collected as source, right? Now, this is an information that we should know. Coming to the next step is, I think, who pays income tax. So if you look at, these are the people who are paying income tax. You have Hindu undivided family, you have body of individuals, you have association of persons, you have local authorities, you have companies and corporate firms, and you have all artificial judicial persons. I'll briefly explain this across. Uh, Under Hindu undivided family, Hindus, Sikhs, Parsis, Jains, Buddhists, all come. They can have, they can pay taxes specific to them as individuals and also together as a family. If they want to do that, they would apply for a PAN card for the family, and whatever tax exemptions and benefits which are applicable to an individual, it also becomes applicable on the entire family, and this helps the whole family save taxes, right? However, there are some disclaimers around. So for example, if I and my family go about moving from individual tax payment, and we add HUF also as an option of making taxes, and I have purchased a house, if the whole family is claiming tax exemption under, let's say, home loan or the interest or the principal of home loan, then everybody also in a way becomes equal owners. But apart from that, I think from the time of marriage to the time of having kids, or if you're staying in joint families, then you can opt for not only your PAN card, but also HUF PAN card, which allows you to pay taxes for the whole family as well as all individuals on their own, right? When we talk about body of individuals, it is talking about only individuals. When we are talking about association of persons, this is talking about not only individuals, but also legal entities. You can have a group of people coming together, working together, making earnings. You can have proprietors. You can have individuals who are proprietors. So all that would come under associations of persons. I think local authority is self-explanatory, corporate firms are self-explanatory, companies are self-explanatory, and when we talk about all artificial juridical persons, then partnerships come into picture, NGOs come into picture, a lot of other additional inputs come into picture. It can also mean, it does not only cover Indians, it also covers people who are making an earning in India through a firm or individually. All that comes under that. So these are the people who are paying income tax. Yeah. Guys, can you hear me? I can see a message, voice breaking in between. Are you able to hear me clearly? Okay. Uh, just give me a second. I think I can see a raised hand. Um, give me a second. Rajesh, you can type your message across a lot of times. If I give an access of conversation, then a lot of background noise comes into the webinar, and that disturbs this across. So if you have any doubts, you can probably, so as of now, do you have any doubts, any questions? Okay, wonderful. You can hear me clearly. That's really great. Uh, any Guys, any doubts so far? Okay, great. So TCS is settled, just how any income tax. So it would come under slabs. It would come under. It's just that the tax liability is being pushed by not allowing somebody to deduct those taxes, but to pay taxes over and above. The tax amount remains the same. So if tax amount is 100 rupees, then tax amount will remain 100 rupees in both the cases. It's just that it's not being deducted, but it's being collected. That's the that's the key. It may be beneficial because, for example, you are making an X person pay taxes for you. So for example, let's say you are a freelancer and you are you are working with various companies doing maybe training or some other kind of work. So when these companies are paying you as a mandate, they have to go about deducting 10% of taxes from you. However, if if you want these taxes not to be deducted, then they can then you can suggest them that they should not go about deducting these taxes, and they will end up paying these taxes over and above what your earnings are, and then it's then you can go about paying those taxes. So in a way, in a way, it again depends on the agreement of the contract that you have. But in a way, what works, which may work in this case, is that you can have additional savings. However, if yeah, if things are more or less the same, then your net tax output remains the same. It does not change. So then in those cases, you will not have any benefit. So it can be between companies to company. It can be how TCS is collected by a company or any firms. It can be company to company. It can be company to an individual as well. TCS, as we are talking about budget related to HRI, and HRs deal with more individuals across, I would want to focus more on that. But I think this is a very good question, because when you say that how TCS is collected by companies or any firms, so for example, let's say if there is a company A and a company B and both have done business, and then company A goes about billing company B, then they can say that over and above the service that has been provided, we would want income tax to be collected from you. So you bear the burden of income tax, and as part of invoice, you would or invoicing or collecting procedure, you would go about adding another row in which you would claim that tax, and on that tax being collected, you would have to pay it monthly or quarterly depending on the segment that you come in, right? So it would just remain the same. For example, normally what happens is in TDS, your tax will get deducted, and then after the financial year is over, in the next year, you would claim those taxes and show that all these taxes are deducted. So you will have your net tax payable, and you will minus that from all that has been already deducted, and whatever is remaining is something that you would go about paying. In tax collected, yeah, you can say it's a kind of advance tax collection. However, it's not when you say that people are doing self-proclamation of tax here. Different companies are also showing in their legal books. So basically, it's little more sound process in terms of not being able to evade taxes. Is that clear? Okay, now, so just a quick brief. We talked about direct and indirect taxes. Income tax is a direct tax. We created an understanding of this. We also talked about taxes in terms of how taxes are collected. And we also talked about the various structures in terms of who goes about paying the income tax, right? Now, when it comes to all individuals, now whether they come under HUF, whether they are salaried employees, whether they are under a body of individuals, or any of the criteria that we spoke about, end of the day, as an individual, if you're paying tax, not as a company, but as an individual, and that is what HRs are also worried about. HRs are worried about, I would not say worried, but as part of their role, you should not be worried about it. I know tax, the term itself is little worrisome, but the idea is that you are computing and helping in through compensation, benefit, payroll processes, other people, the taxes that other people have to pay. So in that case, we have to have an understanding of what is the tax structure for individuals. So there are three broad structures under which tax is divided. One is individuals less than 60 years of age. The second one is senior citizens, which are 60 to 80 years of age. And then you have super senior citizens, which are 80, over 80 and above years of age. Yeah. Now, when we talk about income tax structure or slabs in India, there are you all know that, I mean, I'm sure that you would have followed news and you would have seen that there has been a old tax existing structure, and there has been a new tax structure that has been introduced for budget 2020 onwards, right? So one more thing that I would like to make clear to everybody here is that there are two terms which are widely used in income tax. One is FY, which is financial year, and second one is AY, which is assessment year, right? So when we talk about FY, for example, currently we are in FY 2019 2020, isn't it? 2019 2020, we are in financial year 2019 2020. However, when will we be paying the taxes, or when the filing and everything would happen? It would happen in assessment year 2021, which technically means we will be filing the taxes. We would be paying taxes now, but we would be filing the taxes in next financial year. So the assessment year for this financial year would be 2021, right? So technically there are two slabs currently. One is old or existing slabs. Existing slab, which is applicable for this year. From the next financial year, which is from April 1st, 2020, you will have a choice of a new slab, and I would be talking about that as well, right? And the slab that would be applicable for the new financial year from April 1st, that would be assessed in 21-22, right? So just, I mean, sometimes this creates confusion, but just for a basic understanding, remember that assessment year is one financial year ahead of this financial year. That is how exactly, when you go about filing that, the AY is +1 of the current FY, and that's why you go, that's how you go about calculating. However, now income tax is going a massive change, and I think all of you who are listening, you have shown interest in terms of understanding this, and it's very, very important, because this is just the start of the change. As we move ahead, there would be a lot of changes that we would foresee. However, there is something that currently which is old but is also existing. When I say existing, it will not only exist now. Government has given us a choice of choosing between old or existing slab, or take the new slab. And also note that as salaried employees, moving between these two slabs as of now can be done n number of times, which technically means that you can choose old existing slab for this year, and next year if you feel that you are saving more, you can go with choosing the new slab, and after next year you can again go for old slab, and 4 years down the line you can choose new slab. It's a choice that you can go about making. But if you are a business person, then you can only do it once, which means if you're running a business and you have business income and you're not a salaried employee, then you can only do it once, which means if you currently are in old or existing slab, and if you choose new slab, then you cannot go back to old and existing slab. So with salaried employees, this flexibility of moving from old slab to new slab, old slab to new slab is there n number of times. But for business persons who are filing tax through business income, it can only be done once, right? But as of now, we have two structures. So one interesting part is, and if you look at how things have changed, it's very interesting, because earlier it was not about two structures, it was about treating men and women differently. So men had less exemptions, women had more exemptions. But now if you look at in last 3 years, 4 years, what we have seen is that men and women, the tax slabs are same, exemptions are same, and now what has been proposed is a old structure and a new structure, right? And we will get into details of it now, right? So now coming to creating an understanding of old or existing tax structure. So I'm using old and existing again and again because it has been running for this year. So it is old, but it is existing, which means this choice will also be available to us next financial year. Is my voice clear? Guys, is everybody able to hear? Okay, okay. So I think if everybody is able to hear, then I think if somebody is not able to hear, they have to check internet connection from their end. Yeah. So now this is the existing structure. 0 to 2,50,000, there is no tax. 2,50,000 to 5 lakh, there is 5% tax. 5 lakh to 10 lakh, there is 20% tax, and above 10 lakh, there is 30% tax. Now this is the current tax structure. This is the current tax structure that we are following, or you can also call it old, or the existing slabs that we would be paying taxes for this financial year, right? Now we have to understand that now one of the important sections that we have to understand here is section 87A. Now 87A is applicable in both old as well as new regime, old regime as well as new regime. So this is important that we understand that. Now what 87A says, that if your net taxable income, so you will have a taxable income, and then you will reduce exemptions and take exemptions and savings and investment, if you deduct all of that, and then you have a net taxable income. And if that net taxable income is up to 5 lakh, which is 5 lakh and less, then the 5% tax slab that we are talking about, you will not be paying anything. You will not be paying anything, right? But if your income is more than 5 lakhs, your net taxable income is more than 5 lakhs, then you will be paying 5% for that slab, right? And what is 5% of the slab between 2,50,000 to 5 lakh? It is 5% of 2.5 lakh, right? Which is 12,500 rupees. So you will end up paying 12,500 rupees if your net taxable income is more than 5 lakh. So this feeling that we get that up to 5 lakhs there is no tax is true only for people whose net taxable income is up to 5 lakhs. The moment your net taxable income is more than 5 lakhs, you will be paying 5% from the slab of 2,50,000 to 5 lakhs, right? So you will be paying tax in between this. So that is something that we have to understand. So this assumption that 0 to 5 lakh there is no tax is wrong if you're earning, if your net taxable income is more than 5 lakhs. Is that clear? Right? Quickly, I will repeat again 87A. 87A is important because it's applicable on both the tax slab, right? What this says, so basically, if you look at the old tax structure, it says 0 to 2.5 lakh, zero tax, which means you will not be paying any tax. 2.5 to 5 lakh, there is 5% tax. Now, this 5% you will not be paying if your earnings or your net taxable income is 5 lakhs, right? So let's say you are earning 4,50,000 rupees, then you will not be paying 5%. If your earnings is 4 lakhs or 5 lakhs, you will not be paying the 5% in this slab. You will only be paying 5% in this slab if you cross this slab. If your net taxable income is, let's say, 6 lakh or 5,50,000 or 5,20,000 or anything more than 5 lakh, you will be paying 5% in this slab. So what is 5% of the slab? 5% of 2,50,000 to 5 lakh. So basically it is how much do you earn in this slab? You earn 2,50,000 in this slab, isn't it? 5 lakh minus 2,50,000. So it's 2,50,000 is what you earn in this slab. 5% of that amount is what you would be paying as tax, which is 12,500 rupees. So your net saving under 87A is 12,500 rupees, and this is only applicable to you if your earnings or net taxable income is less than 5 lakhs. Is that clear? Okay, great. Now, right? So if you see, this is what it would then come across for people who are earning more than 5 lakhs or whose net taxable income is more than 5 lakh. This is what would apply. So up to 2,50,000, there would be no tax. 2,50,000 to 5 lakh, 5% of total income exceeding 2,50,000. Now, if you are coming in the tax slab of 5 lakh to 10 lakh, then the previous one is 12,500 plus 20% of total income exceeding 5 lakhs. Now, if you are earning more than 10 lakhs, then the maximum taxable amount for the slab between 5 lakh to 10 lakh is 1 lakh, and 12,500 is for the slab before that. So your net taxable income would be 1,12,500 plus 30% of total taxes. Is it clear? Is it clear? Can you make the sense out of it? Yeah. All of you can make a sense out of it. So if you see 2,50,000 to 5 lakh, if you're earning more than 5 lakh, you are paying 12,500 rupees for the slab before, and then 20% of total income. So let's say we do a calculation for a person earning 12 lakh, right? Let's do a calculation for a person earning 12 lakh. What would it be? If a person is earning 12 lakh, then 0 to 2.5, he would be earning nil. If you have a pen and a paper or an Excel sheet, you can make a note of it just to get a clarification. 2 lakh, 2,50,000 to 5 lakh, how much tax he is paying? He is paying 12,500 tax. 5 lakh to 10 lakh, how much he'll pay? He'll pay 20% of 5 lakhs, right? 5 lakh to 10 lakh. The net earning in that slab is 5 lakh. So 20% of 5 lakh, which is 1 lakh, right? And 10 to 12 lakh, 10 to 12 lakh, it is 30%. So 10 to 12 lakh is 30% of 2 lakhs. 30% of 2 lakhs will be 60,000 rupees, right? And so if a person is, the net taxable income is 12 lakhs, then the person would be paying a total of 1,72,500 rupees as tax. 1,72,500 as tax. Why? 0 to 2.5 nil, 2.5 to 5 The net taxable income is 12,500, 5 to 10 lakhs, 20% of 5 lakhs, which is 1 lakh. So when we go in the last slab, we are already paying 1,12,500 at tax. And now in the last slab, which is above 10 lakh, our earning is 2 lakhs. So we are paying 30% of total income exceeding 10 lakhs, which is 2 lakhs, which is 60,000. So now the net tax payable by us is 1 lakh plus 60,000 plus 12,500, which is 1,72,500. Is it clear to everybody? Okay, great. Now for senior citizens, there is a small exemption in the old tax regime, which is 0 to 3 lakhs, there would be no tax. 3 to 5, it would be 5% as for people who are less than 60. 5 to 10, it is 20%, just how it was for people earning below 60 years, and income more than 10 lakhs, it's 30%. So everything is same. The only thing that changes is that instead of 0 to 2.5, which was nil tax, here it is 0 to 3, right? And for super senior citizens, which are 80 and above, 0 to 5 is nil, and 5 to 10, it is 20%, and 10 and above is 30%, right? Now here I would want to make all of you understand that the slabs for senior and super senior citizens is not there in new tax regime. It treats everybody equally irrespective of their age, right? So if a super senior citizen or a senior citizen, or if you have employees working which are plus 60, right, mostly that can be the case. Above 80 might not be the case, but for in case of senior citizens, if there are employees working, like a lot of people do work in colleges, institutions, and elsewhere, right? If you have people working more than 60, then if they move to new tax regime, they will not be treated as under special tax exemption for senior and super seniors, right? It is only applicable in the old tax regime, right? So if you look at, this is what it would look like, right? Yeah. If I'm just putting what we did discuss in last 3 slabs together, right? What we put in last 3 slabs together, if we compare between various age groups, this is what we see. Is it clear? Right? Yeah. Okay, great. So this is old or existing tax regime. Remember, people less than 60, 0 to 2.5 nil, 60 to 80, 0 to 3 nil, 80 and above, 0 to 5 nil. Rest everything remains the same. Slab wise, if your earning is from 3 to 5 lakh, it remains 5%. For super seniors, your earning between 5 to 10 lakh, it's 20%, and same all across. Is it clear? Okay. Now talking about new tax slabs for 2021, right? Now these are the new tax slabs for 2021. 0 to 2.5 lakh. So this is what has happened in new tax slab. If you carefully look at the new tax slabs, what we can foresee is that there are many new slabs that have been introduced with a lower rate of taxation. So rate of taxation is less, and there are a lot of breakups in between where we have more options in terms of number of slabs with reduced rate of taxation. So if we look at the old tax, it was 0 to 2.5, 2.5 to 5, 5 to 10, and 10 and above, and then 5% nil, 5%, 10%, nil, 5%, 20%, and 30% applied in the old tax slab. Here, 0 to 2.5 is nil, 2.5 to 5 is 5 lakh, and the same 87A that I explained in detail also applies in here, right? 5 to 7.5 is 10%, 7.5 to 10 lakhs is 15%, 10 to 12.5 lakh is 20%, 12.5 to 15 lakh is 25%, and people earning 15 lakh and above now pay 30%, right? 30% in the old slab was being paid by people earning more than 10 lakhs. Here, people earning more than 15 lakhs will be paying 30%. So these are the tax slab. These are the new tax structure that has been proposed in the budget this year for 2020 and 21. Right now, what we will do is very interesting. We will, as we move forward, we will understand the impact of exemption on the old and new, and then we will do a very interesting calculation to see what tax structure, old or new, would work better for us, right? So we will do all of that today. But just for a quick comparison, please note, just look at the first column, which is general category, just for easy understanding. 0 to 2.5 nil, 2.5 to 5 is 5%, 5 to 10 is 20%, and above 10 is 30%. Here, 0 to 2.5 nil, 2.5 to 5 lakh is 5%, 5 to 7.5. So it's 2.5 lakh ka gap that we can see. 10%, 7.5 to 10 lakh, 15%, 10 lakh to 12.5 lakh is 20%, 12.5 to 15 lakh is 25%, and 15 lakh and above is 30%. Yeah, right? Also note, this is universal, right? A health and education cess of 4% of the taxable income is applicable in both old and new regime. So let's say if I was earning 5 lakh and my net taxable income was 12,500, or how we calculated for 12 lakhs, we calculated 1,72,500, isn't it? How did we calculate 1,72,500? 0 to 2.5, there was no tax. 2.5 to 5, we paid a tax of 12,500. 5 to 10 lakh, we paid a tax of 20%, which is amounting to 1 lakh. And for 2 lakhs, which is 10 to 12 lakh, we paid 60,000. So we paid 1,72,500 as total tax. Of this amount, 4% will be added. So 4% of this amount, which is 6,900, will get added to 1,72,000, 1,72,500. 6,900 will be added. So your net taxable income would then be 1,86,300. Is it clear? So when we say 4%, it is not of the total of your total earnings. 4% of the income tax. So whatever income tax is finally calculated, whatever income tax you would be finally paying, 4% of that amount. So if you're paying 100 rupees as income tax, 4% of 100 rupees, which is 104 rupees, will be paid as health and education cess, both in old as well as new tax regime. Is it clear? Is it clear to everybody? So in total income tax has two components. Net income tax plus education, health and education cess is equal to total income tax. Is it clear to everybody? Okay. Now let's also understand tax on rich, right? So according to the budget, who is rich? People earning above 50 lakhs per annum are rich. So a tax surcharge is added to the net income tax. Now this is also calculated the same way as the health and education cess is calculated, right? Health and how is the health and education cess being calculated? It's being calculated on the net tax payable, right? So this the surcharges would also be on net tax payable. So if somebody is earning 50 lakh to 1 crore, 10% surcharge would apply. 1 crore to 2 crore, 15% surcharge would apply. 2 crore to 5 crore, 25% surcharge would apply. And people earning more than 5 crore per annum, 37% surcharge would apply. Apart from this 37% surcharge, they would also be paying 4% health and education cess. Now, kindly note that even if somebody chooses the old regime, the moment a person earns more than 50 lakhs, this is what would apply to them. So if a person was choosing old regime, it doesn't mean this would not apply to them. This is universal again for both old as well as new regime, right? Under the section of tax on rich, right? Surcharge is an additional charge on your net tax payable. So if my net tax payable, let's say, was 10 lakhs, I'll pay a 10% surcharge, which is, what is the 10% surcharge, which is equal to 1 lakh rupees. So I'll be paying 1 lakh if my earnings are between 50 lakh and 1 crore. Clear to everybody? A quick yes would help, right? Okay, wonderful. Okay. Right. Yeah. Right. So let's say somebody is earning 51 lakhs, right? If somebody is earning 51 lakhs, then up to 10 lakh, you can choose the old column or a new column, or I'll just take this example towards the end. Just I'll put it in the parking lot for now, Akanksha. Just remind me this, and I'll probably open up an Excel sheet and I'll do this across for you and for everyone once we move towards. But just remember that when we go about calculating the income tax, whatever income tax you pay, if your earnings are between 50 lakh, if your net taxable income is between 50 lakh to 1 crore, an additional 10% of that amount would apply, and an additional 4% any which way you are paying as health and education cess. That is something. So if you look at the last column, this is how exactly it would, this is how you will calculate. Let's say a person earning 1 crore. What will he pay? 0 to 2.5, nil, 2.5 to 5, 5%, 5 to 7.5, 10%, 7.5 to 10, 15%, 10 to 12.5, 20%, 12.5 to 15, 25%, and 15 to 50 lakhs, 30%, right? So this is only for super rich. It is the surcharge is for super rich, which means, or you can call it rich. So if your net earnings is more than 50 lakhs, that's when you come into that category. Or if your net taxable income is more than 50 lakhs, that's when you come under that category. You don't come under the category if somebody is earning 40 lakhs, 45 lakhs, 50 lakhs, up to 50 lakhs. If you are, then you are normally paying on the structure of up to 30%. Only when you earn more than 50 lakhs, that's when this comes into picture, right? Now, surcharge is only applicable for people earning more than 50 lakhs. However, health and education cess is applicable on everybody. The 4% of income tax amount is applicable on everybody, right? Okay. Now this is something which is very, very important. Role of exemptions. We have to understand role of exemptions, because the difference, now what looks so easy for us so far in terms of, if you look at old tax regime, right? If you look at the old tax regime, you feel that, that the tax slabs are lesser, and you are paying higher tax. And if you look at the new tax regime, you feel that the tax slabs are more and you are paying lower taxes. But there is a catch, and that catch is understanding the exemptions and its applicability on the old regime as well as the new regime. Okay, I can see another question. Is ECS and surcharge compulsory to pay now? No, your company is earning, it's not something as an individual. What is your earning? When if you're talking about company that a different income tax apply, right? That is in the range of 25 to 30% flat. Or if your net income of your company is less than 2 crore, or now from next financial year up to 5 crore, then you can pay under composition tax regime of where you can pay 8% or 10% as tax. That is something that you can do, right, in terms of income tax. But I'm talking about individuals. I'm not talking about companies or firms. Is your questions related to, so there has been a question that has been asked, is ECS and surcharge compulsory to pay? What if super rich and rich, as my company is earning above 50 lakhs? So you're talking about as an individual or as a company? We are discussing tax structure for individuals. As HRs, we have to take care and drive taxation savings for employees, right? Okay. No, individual and company, if you are a proprietor and you're looking at that, then you go and choose company route to pay taxes, because there you would be able to save more. And 30% of net profits would apply, or under composition of scheme, you can pay a flat 8% or 10% of the total revenue. That is something that you can do, right? But if you are salaried, that's when, or if you are even, or if your earnings as individuals are between that range, that's when you go about paying those taxes, right? Yeah, I got it. I understood when you said employee and individual and company. I understood you're a proprietor. So what would suit you better is to choose the route of paying through company taxes. That is what would suit you, right? Okay. Now let's understand role of exemptions. Role of exemptions, which is very, very important, right? Now, in old regime, all exemptions which were allowed are still allowed, right? It works as it was working before. In the new regime, majority of exemptions are not allowed, right? About 70 exemptions has been not allowed in the new regime, right? There are some clarity that is needed on few things like food coupons, etc., which is still not very clear with the budget document that is out. But all that otherwise that we use in a payslip, apart from food coupons, that food coupons clarity, because food coupons is part of payslip, so HR should know whether exemptions on that is possible or not. Earlier, exemption on food coupons was allowed. Now, whether it is allowed or not is yet not clear. So, except for food coupons, which is not clear as of now, most of it, what you would see in a pay slip or what could have been claimed as exemption is not allowed under the new regime. In the old regime, it is as it is. It can be claimed, right? So I would probably, as I move ahead, I would take examples as well. But let's first understand that what are the exemptions that we are talking about, right? So what are the list of most used exemptions by employees, right? So these are list of exemptions which are most used by employees. So you have standard deduction for up to 50,000. So earlier there was medical and travel, and then medical and travel separately was removed, and the concept of standard deduction came into picture, and an amount of up to 50,000 could have been claimed as exemption for standard deduction. So that is one of the used exemption. This can be taken in the old regime, cannot be taken in the new regime. Now, then you have HRA exemption. HRA is house rent allowance, and it is for people staying in rented accommodation. HRA applies, so there are three conditions for HRA, and the minimum amount for the three is taken as HRA exemption. The deduction is available in the least of the following amounts. A is actual HRA received, so whatever actual HRA you received. Second is 50% of basic plus DA, or only basic if you're living in metro, and 40% for non-metro, right? And third is actual rent paid less than 10% of basic salary plus DA, right? Yeah, actual rent paid, whatever actual rent you are paying minus 10% of salary, right? Minus 10% of not salary, 10% of basic or basic plus DA, right? So when you calculate this as an HRA, then when you calculate this as an HRA, then minimum of the three, whichever. So let's say for A, you got 50,000, for B you got 40,000, and for C you got 36,000, then 36,000 can be claimed as exemption. Now, if you are in a metro, basically metro by law has been defined as 4 cities, which is Delhi, Mumbai, Kolkata, and Chennai. Right? Everything apart from this, irrespective whether the cost of living is more or less, is considered to be a non-metro. However, the choice of 40% or 50% is a company specific choice. And even in a non-metro, you can see, so for example, if you're talking about Pune, or if you're talking about Bangalore, or you're talking about Hyderabad, you may find companies which are paying 40%, or you may find companies which are paying 50%. So it's a company's choice end of the day. However, by law, what gets defined as a metro is the 4 metros that we know, Delhi, Kolkata, Mumbai, and Chennai, right? Then you have LTA exemption and you have professional tax exemption, right? So these are some exemptions that people take. So whatever professional tax you are paying, you deduct it from your net earnings and then you pay. So let's say your earning is 10 lakhs. Now standard deduction 50,000 you deduct. Then let's say HRA also is 50,000, you deduct another 50,000, it becomes 9 lakhs. Then you have LTA of let's say 20,000, so you deduct another 20, and you have professional tax another 20 or 30. So from 10 lakhs, now it becomes 8.5 lakhs considering these exemptions, right? Yeah. So basically these exemptions are something that can be claimed. The list continues. There are more exemptions as well. There has been a question that has been asked. Do we have fixed HRA in some companies? You can have a fixed HRA in some companies. In that case as well, the calculation would remain the same. Actual HRA received, 50 or 40, whatever the HRA the company is paying, and whatever actual rent you are paying minus 10% of basic plus DA. You will do this calculation, and whichever is minimum, you will consider it for exemption. So even if somebody is giving you a fixed HRA, still this calculation still is possible, and you can go about doing this calculation and then coming up to a conclusion of what is the exemption that you can go about claiming, right? Just to give you a simple example of an HRA exemption, if let's say we are talking about somebody earning 6 lakh and let's say the basic which is 1 lakh rupee per month, and basic plus DA, or basic is about 40%, which is about 40,000 rupees. In that case, HRA normally, let's say for a non-metro, would be 40% of basic, which is 16,000 rupees. If you talk about this 16,000 rupees as into per annum, we are talking about 1,92,000 rupees as HRA. So if you, under condition A, it would be 1,92,000 because that's the actual HRA you have received. In condition B, it would be 40% of basic, which again remains 1,92,000. And in condition C, which is actual rent paid. So let's say, what is the actual rent you are paying? Let's say actual rent is what you are paying is, let's say 20,000 rupees per month. So in a year you are paying 2,40,000 minus 10% of basic. Now 10% of basic, what is your basic per annum? If 6 lakh is your total salary per annum, 40% of that which is no, actually, if it's your 12 lakh, let's say you're earning 1 lakh per month, right? If you're earning 1 lakh per month, then your basic is 40,000 per month and 4,80,000 per annum. 4,80,000 per annum, right? 4,80,000 per annum. Is it clear? So if you're earning 1 lakh per month, which is 12 lakh per annum salary, your basic is 40% of your per month salary, which is 40,000 rupees. Your HRA is 16,000, which is 40% of 40,000. And if we just compute this on a per annum basis, then 10% of your basic salary, which is 10% of 4 lakh 80, which is 10% of 4 lakh 80, which is 48,000 rupees. So it would be 2,40,000 minus 48,000. So it would be 1,92,000 again. In that case, the HRA exemption that can be claimed in both all the three conditions, A, B, and C, is 1,92,000, which is flat. So you can choose any condition. However, if you were paying, let's say, same rent as what HRA you were getting, in that case, it would be 1,92,000 is the HRA that you are receiving. So that's the rent you are paying minus 48,000, which is 10% of your basic per annum. It is 1,44,000 rupees. So if it's 1,44,000 rupees, then condition A is 1,92,000, condition B is 1,92,000, and condition C is 1,44,000. So the exemption that you can claim is 1,44,000 rupees. Right? Okay. So let me move on this again. I'll come back to HRA exemption again. So two questions that I would take care is, one is on how super rich taxation would work and how HRA exemption will work. But just to give you an HRA exemption, these are simple calculations. One is actual HRA received. Whatever HRA you are receiving, you will put that across. Second is you will calculate, and remember, income tax is all in per annum. So if it's 40% for a non-metro, then it would be 40% of basic plus DA per annum. That is something that you will take off. And third is actual rent paid minus 10% of basic plus DA. So you will put all these threes across, and whichever is minimum is something that is taken as exemption. Right? That is something that you would be considering. I'll again explain HR exemption in some time. But apart from that, so what are we talking about is that exemptions get missed, right? Exemptions get exemptions are not considered in new tax regime. It is considered in old tax regime. Now we are trying to understand the most used exemptions as of now. The most used exemptions are standard deduction, HRA exemption, LTA exemption, professional tax, and apart from that, you also have IT section 80C. Under IT section 80C, you have various things like EPF, PPF, ELSS. ELSS is equity linked savings scheme. You have mutual funds, you have national pension fund, you have national savings certificate, you have fixed deposit, you have LIC premium, you have children tuition fee, whether it's school or college, up to 2 children, repayment of home loan, the principal component of it. All this put together, 1,50,000 tax exemption can be claimed under 80C, right? 1 lakh tax exemption can be considered under 80C, right? List of most used exemption also continues with 80D. 80D is medical insurance premium that you pay. Now it is applicable on you, your family, also on your parents. So there are sections under which you can claim this across. Then you have 80E, which is deduction of loan for higher studies. Then you have section 80E, which is of interest on home loan. Then you have children education allowance and some other special allowances. All this can be claimed under exemptions, right? These are most used exemptions in a salary. We are talking about what HRs manage. We are talking about what HRs should know. And as part of a list of exemptions, standard deduction, HRA, LTA, professional tax, 80C, 80D, 80E, 80EE, and other special allowances, which includes food allowance, children education allowance, etc., are all exemptions which are claimed, right? Now coming to now remember, all these exemptions that we are talking about previously, it cannot be claimed. It cannot be claimed. So under the new regime, you cannot claim standard deduction. Under the new regime, you cannot claim HRA exemption. Under the new regime, you cannot claim LTA, professional tax. You also cannot claim 80C. You can also cannot claim 80D. You cannot claim 80E, 80EE, and other special allowances in child education. All this cannot be claimed under the new regime, new tax regime. However, all of this can be claimed under the old tax regime. There are few things which still can be claimed. There are few things which still can be claimed, right? For example, interest on home loan, on rented out property. So let's say you have bought a house and you have rented it out to somebody, then the interest that bank is charging you minus the rental that you are getting, that amount is exempted. That amount is exempted, right? Even in the new tax regime, this amount will be exempted. Is it clear? If you have bought a house on loan and you have rented it out, then the difference of interest, not principal, difference of interest that the bank is charging minus the rent that you are receiving, the remaining amount will be exempted from tax, right? And for the first time house buyers, interest, home loan interest of up to 1.5 lakh as exemptions has been extended for the next financial year. So that also has been done, right? So so you cannot claim 80C, which means principal of home loan you cannot claim. EPF you cannot claim a lot of other things that we mentioned earlier in terms of standard deduction, HRA, LTA. However, interest on home loan for rented out property and interest on home loan for first time home buyers is still applicable. Still applicable. What is also applicable is that if your employer is what is employer contribution towards the pension fund. So under EPF, under provident fund, money goes into pension fund as well. So money that is going to pension fund or you can also go about buying pension fund. So you have various pension schemes that are available in the market. If you are opting for that, then that also is exempted under this, only for pension, which means very long-term fixed savings, fixed deposit for 3 years or 5 years, or ULIP or equity-linked saving schemes or mutual funds, which were quick saving instruments. Under new regime will not help you save taxes. However, something very long, which talks about superannuation, which talks about pensions, investment in that will still be exempt from taxes. Is it clear? Right? Right. But the total net deposits that you are doing per annum should not exceed 7.5 lakhs. It is applicable only for deposits up to 7.5 lakhs. Right? Okay. Now, what else is exemptions which are still applicable on the new tax regime? Interest received on post office savings of account. So if you have a post office account as a single account owner, 3,500 of interest. So if you put money, you are getting interest on that, right? So 3,500 of interest amount is exempted. As a joint account holder, 7,000 is exempted. So interest received on post office is exempted. Gratuity received from employer up to 20 lakh in a lifetime is exempted. Amount received on maturity of life insurance is exempted. Interest received up to 9.5% per annum for PF is exempted. Interest and maturity amount for PPF is exempted. Leave encashment. So a lot of times when you are leaving a company, as part of full and final settlement, you get leave encashment. So up to 3 lakh is exempted. Payment received from so if your NPS account is paying you back, right, or you have taken a VRS, then all that amount is still exempted even if you go to the new tax regime. So this is true for both old as well as new tax regimes. NPS is National Pension Scheme and VRS is Voluntary Retirement Scheme. So NPS is more like a pension fund that we are talking about, and VRS is people who opt for early retirement, right? So all this list of exemption is still applicable in the new tax regime, and it's not account. VRS amount I have written. NPS is account. So if you open up a pension fund account, that account you will receive money. You will link your bank account with the national pension fund, and when it matures, you get money back into that account. That would be exempted from tax, both in old as well as new tax regime. VRS is, if you take early retirement, you get a lot of money because it's an early retirement, just like all the retirement money that you will get, including all your PF savings, leave encashment, etc., etc. All that would come together, and that would come in one financial year. Still, it would not be taxed. Right? So all these exemptions would still apply. Interest from PF exemption is allowed. And yes, so interest received up to 9.5% per annum for EPF is exempted. It is exempted under even the existing as well as new tax regime. So I think PF can be about 8.65% as of now, but up to 9.5% the interest that you are getting, both in old. So all this is already applicable in old tax regime. Some of it is not applicable in new tax regime, and some of it is applicable on tax regime. So just to clarify that these are the things which are not applicable. These are not applicable. What I have mentioned here in terms of standard deduction, HRA, LTA, professional tax, ATC, ATD, ATE, ATE, etc. is not applicable. However, these are the things which are still, the exemption is applicable both in the old regime as well as the new regime. Is it clear? Is it clear, everyone? Wonderful, great. So now let's take an example. Now we will take a very interesting example, and we will see 2 rounds of calculation. Just I think you, I would suggest you read about VRS, because VRS amount getting fixed for new tax slab is not relevant, because VRS is like a retirement, right? So we are talking about retirement here. Somebody is taking an early retirement, a voluntary retirement. So that, a completely different thing applies on that. For a particular year, the earnings become more, but already you have paid a lot of taxes for all your previous years. So this year, the VRS tax is, you don't pay taxes on your VRS earnings. That is what it amounts to, right? But I would advise VRS can be read little more, because that understanding will help you to what I'm trying to put across here, right? These are just a list of what is under new regime, what is still applicable, what exemptions are still applicable, right? All this are still applicable. Right. Now, let me take an example. And here I would want everybody's attention, because if you don't understand this, then these calculations only these calculations will help you calculate for any, for your earnings or for anybody's earnings as HR. So these calculations are really, really important, right? Okay. Now, coming to, actually, this is case 1. Right? This is case 1, not case 2. Let's talk about case 1, where a person is saving less. And so let's again, let me just put this across of how the tax structures are working, right? So you have this old regime. In old regime, you have less number of slabs and you have higher income tax rate. However, exemptions are allowed. How are you getting those exemptions? You are getting those exemptions because either you are saving money, you are investing money, right? You are donating money. So if you're using those tax instruments, or you're taking a loan, so basically when you're taking loans, savings, investments, donations, you are getting to save money, right? You are able to claim all of that in the old regime. So old regime has higher tax slabs, higher tax rates, less number of slabs, higher tax rates, but it allows you to save using instruments where you are either taking a loan or saving or doing investments, right? In the new tax regime, the tax rates are less, the slabs are more in number, But the way you can save by investing or taking a loan or otherwise, those instruments are almost not there, right? So now how do we choose which regime to go for, or as HRs, how do we advise which regime to go for? Now this example would clarify that across. So here we will take two cases, case one, which is of lower saving, and then case two, which is of higher saving. So forget the Roman numerical mistake that I have done where it's case one. Case one is of lower saving. So in the old or existing regime, now this is an example for old or existing regime, the net salary of the person is 7,50,000 rupees. What is the net salary of the person? 7,50,000 rupees. What are the exemptions the person is claiming? The exemption the person is claiming is standard deduction of 50,000 rupees. And under IT section 80C, what comes under IT section 80C? Under IT section 80C, you have children tuition fee, repayment of home loan, the principal part, and any LIC premium that you are paying, any NSC investment that you have made, any fixed deposit that you have taken, mutual fund, ELSS, etc. All this comes under 80C. So let's say under 80C, this person is saving another 50,000. Now this is an assumption, right? Please understand, we are doing an assumption that let's say in PF X amount goes in, this X amount goes or Y amount goes. The net saving per annum is 50,000 under IT section 80C, plus there is a standard deduction of 50,000. So what is the net exemption being claimed by this individual who is earning 7,50,000? The net exemption claimed is INR 1 lakh or rupees 1 lakh, right? So what is the net taxable income now? The net taxable income is 6,50,000. So his earnings are 7,50,000. 1 lakh is getting exempted. So his net taxable income now is 6,50,000 rupees. Now let's start calculating. If you see 0 to 2.5, no tax. So you don't pay any tax on that slab. 2.5 to 5, the taxable percentage is 5% in the old regime. Remember, this is the old or existing regime that we are talking about, is 5%. Now 87A does not apply here because if you see the net taxable income is 6,50,000. So it is more than 5 lakhs. So he'll end up paying 5% within that slab. So what is the slab? 2.5 to 5 lakh. So 5% of 2.5 to 5 lakh is 2.5 lakh, and 5% of 2.5 lakh is 12,500 rupees. So you'll be paying 12,500 rupees tax here. Now what is the net taxable income? Net taxable income is 6.5 lakhs. So 5 to 6.5 lakhs, the tax rate of taxation is 20% as per the old regime. So 1.5 lakh ka 20%. 5 to 6.5 lakh. What is the amount? 1.5 lakh. 20% of 1.5 lakh. How much it is? 30,000 rupees. So what is the net tax payable? 42,500. How do we arrive at 42,500? 12,500 under slab 2 and 30,000 under slab 3. So net is 42,500 plus health and education cess. What is the amount? 4%. 4% of 42,500, which is 1,700. So net tax payable is 44,200. The net tax payable is 44,200. Clear to everyone? Guys, I want a quick yes by everyone if they have understood this. Right? So net tax payable is 44,200 in this case, 0 to 2.5 lakh, which is slab 1, no tax applied. 2.5 to 5 lakh, there is 5% tax within that slab, which is 5% of 2,50,000, which is 12,500 rupees. Slab 3 is 5 to 6.5 lakh, which is 20% of 1.5 lakh, which is 30,000. Net tax 42,500. Into 0.0 into 4%, which is health and education cess, which is 1,700. Net tax payable becomes 44,200 rupees, right? Yeah. Now, uh, now this is, let's calculate the same thing in new regime. We are calculating the same thing in new regime. Now in new regime, nothing is applicable. So even if you're doing saving, you're not doing saving, it does not matter, right? High or low saving does not matter because technically standard deduction does not apply. IT section 80C does not apply. So if you are earning 7.5 lakh, you are paying tax on 7.5 lakh. Net exemption is 0, right? Now let's calculate for this is again, this is new regime actually, not old and existing regime. This is new regime. Now when you look at the new regime, what is it? 0 to 2.5 lakh, 0 tax will apply. 2.5 to 5, again same, 5% tax on 2.5 lakh, which is 12,500 would apply. However, 5 to 7.5 lakh, as per the new regime, the rate of taxation is 10%, right? So it's 5 to 7.5 lakh. What is there? 2.5 lakh. 10% of 2.5 lakh is 25,000 rupees, right? So net tax is 25,000 plus 12,500, right? Which is 37,500. Health and education cess 1,500. Net tax 39,000 rupees, right? You cannot apply direct tax. You cannot apply direct tax because slabs have to be covered. That's the reason slabs are there. The reason for slabs to be there is that it divides your net earning. It divides your net earning into different slabs, right? Any doubts? Any questions? I'll move ahead now. That's why. Okay, I'm just sharing my screen again. Just give me a second. Just give me a second. Okay, I was here, right? Okay, just give me a second. I have to share. Yeah. Okay. Right. This is what we were discussing. We were discussing new regime, and we were discussing the net tax to be 39,000 rupees. How did we calculate net tax to be 39,000 rupees? Because you remember, you depending on your earnings, you will have to calculate via slab. You cannot directly apply. Directly applying is not possible. 0 to 2.5 lakh, nil tax. 2.5 to 5 lakh, 5% of 2.5 lakhs, which is 12,500. 5 to 7.5 lakh, it is 10%, which is 10% of 2.5 lakh, which is 25,000. So net tax is 37,500. You add education and health cess, which is 1,500. So net tax payable is 39,000 rupees in the new regime. In the new regime, in the old regime, it was 44,200. Where the savings was less. What were the savings? Saving was 50,000 under IT section 80C and 50,000 under standard deduction. So technically, this is what we can conclude in case 1. Here we see savings under new tax regime to be 5,200 more than the old tax regime, right? In this case, where the savings are less, in case 1, where savings are less, it's advisable to go for the new tax regime, not the old tax regime. Yes, it is compulsory to divide. That's why slabs are there, right? The reason for slabs are there that you need to divide. You cannot not divide. You cannot have a flat rate of taxation. That's why you have slab rate of taxation and not flat rate of taxation. So depending on your earning, you will come under a slab, and all previous slabs will apply. right? This is the new tax. Forget it, it's not the old, this is the new, right? So if you see the new taxation page, do you have any doubts? Anybody has any doubts here? Yes. So yes, Praveen. Yes, Ankita. It is 25,000 plus 12,500, and yes, Praveen, 4% of 37, not 37,000, 37,500 basically. What the health and education says is percentage of the net tax payable. Now what I'll do is, right. So I would be now talking about how dynamics will change if we have higher savings. Right? Okay. So now coming to the case 2. Under case 2, we are talking about higher savings. We are talking about higher savings. Standard deduction is 50,000 rupees, and earlier the under IT section 80C, we were talking about 50,000 savings. Now we are talking about 1 lakh savings. So let's say the person has invested little more, or has a loan, or has claimed for child education fee, or whatever under 80C, which is the most used tax slab, exemption slab. The claim is 1 lakh rupee. Again, this is an assumption. So the earning remains the same. Earning is again 7.5 lakh, right? 50,000 is standard deduction, which makes it 7 lakh net taxable, and 1 lakh is 80C, which makes it 6 lakh as net taxable income. So you are claiming exemption for 1.5 lakh out of 7.5 lakh, 50,000 as standard deduction, and under IT section 80C, where up to 1.5 lakh can be claimed, you are claiming 1 lakh. You're not claiming entire 1.5, but you are claiming 1 lakh. Realistic scenario, a person earning 7.5 lakh can anyways claim 50,000 as standard deduction and 1 lakh under 80C. So what is the net taxable income? The net taxable income is 6 lakhs. The net taxable income is 6 lakhs. Let's do the calculation for this, right? Now that the net taxable income is 6 lakhs, you can see that 0 to 2.5 lakh, no tax will apply. 2.5 to 5 lakh, 5% would apply, which is 12,500 rupees. And 5 to 6 lakh, 20% would apply, which is 20% of 1 lakh, which is rupees 20,000 rupees. So the net tax is 12,500 plus 20,000, which is 32,500, which is 32,500. If you see health and education cess getting added to it, it is 1,300. Yeah, it is 1,300, and net tax payable now becomes 33,800. Is it clear? Can you see the calculation? You are not claiming it under new regime. You cannot claim 80C and standard deduction under new regime. You can't claim that, and we have not claimed it. Even in example, we have not claimed it. Right? So just going back again, you can see old and existing regime with less saving. When we talked about less saving, we talked about net saving of only 1 lakh. So net taxable income was 6,50,000 rupees. We were paying under slab 2, 12,500, and under slab 3, 30,000 rupees, which was amounting to 42,500. We were adding health and education cess, which was becoming 44,200 rupees. In example 2, we have claimed more savings under 80C. So our net exemption is 1,50,000 and net taxable amount is 6 lakh. When we calculate that, we see 0 to 2.5 lakh is nil, 2.5 to 5 is 12,500, and 5 to 6 is 20% of 1 lakh, which is 20,000 rupees. So net tax is 32,500. Health and education cess 1,300. The net tax payable is 33,800 rupees. 33,800 rupees, right? Yeah, I mean, yes, you are right. It can be claimed, but as I said, we are making an assumption. So if there is HRA exemption also that you can claim. Now, let's say somebody is not staying in a rented apartment; they're staying with parents, or somebody is staying with in their own house, right? Uh, and they have taken a loan. Then only under 80C they can claim it, right? So this 1 lakh that we are talking about, how principal of home loan is already being claimed under that. Right? So whatever it is, I mean, HRA, if you are staying in an HRA, then HRA exemption can be claimed. Any rented accommodation, an additional HRA exemption can be claimed apart from 80C. But for the purpose of understanding, we have not taken HRA exemption, we have taken 80C and standard deduction, right? Because 80C almost covers most of the exemptions that can be claimed. We have assumed that if you want to do your own calculation and you want to add HRA under the 3 sections that it has, you can go about adding, and you can still reduce the net taxable income more. And that would be absolutely correct to do that, right? But can you see that net taxable income being reduced? Right? Now, if you see the net taxable income being reduced, and now you compare it with the new tax regime, again, let's coming to new regime. Standard deduction, you cannot take. IT section, you cannot take. So net exemption technically is 0. So net taxable income is 7,50,000 rupees. Again, following the same logic of new regime, 0 to 2.5, no tax, 2.5 to 5, 12,500. 5 to 7.5 is 10%, which is 25,000. Exactly the same amount what we calculated earlier. So net tax is 37,500. Health and education cess 1,500. Net tax payable 39,000 rupees. Right? Net tax payable is 39,000 rupees. In this case, we are exactly paying 5,000 more hundred than the 5,200 more than the old regime. So here we should go for the old tax regime. Now look at this example. I've taken this example because our savings in these two examples are exactly the same. If you look at here, it was 5,200 rupees. Exactly 5,200 rupees we were saving in the new regime compared to the old regime. And just by saving some amount more, now we are paying 5,200 less in the old regime compared to the new tax regime. Yes, you're right, Praveen. In the old case, what would also be deducted is if professional tax is applicable in the old regime, that would not be considered. PF would come under IT section 80C, so that also would not be considered for tax calculations, and that would also be considered as tax exemption. You're right. Right. So you can see just by in case 1, we were advising you to go for the new tax regime with a saving of 5,200 rupees, and in case 2, we are talking about going for the old tax regime with a saving of 5,200 from the new tax regime. What does this leave us with then? What does this leave us with then, right? How will it work for us? Very important question. How will it work for us as individuals, as individual taxpayers, and as HRs, right? One thing which is very important is that we have to plan our investments, savings, loans, etc. in advance, right? We have to plan our investments, savings, etc. in advance, right? Second thing is that we have to be more aware. We have to be more aware in terms of what will work with us the best. That is very, very important, right? For example, under old tax regime, which are the exemptions which are allowed? Under the new tax regime, which are not allowed? HRA, you are staying in a rented house. HRA is allowed in own tax regime. It's not allowed in new tax regime, right? 80C is allowed in old tax regime. 80C in new tax regime is not allowed, right? Rented interest on first house, the loan that you have taken is allowed in old tax regime. It's still allowed in new tax regime. Your house which has been rented, but you have taken a loan on that rented house, right? It's your house, you have rented it out. It's allowed in old tax regime, the exemption, and it's also allowed in the new tax regime, right? However, 80D, which is medical insurance for self and family, is allowed in old, it's not allowed in new. Child education fee is allowed in old, it's not allowed in new. So we have to go about calculating income tax exemption based on what is allowed and what is not allowed, right? What is allowed and what is not allowed, right? We have to plan our investment savings, etc. in advance. We have to be more aware in terms of what is happening, what is not happening. We have to have this clarity, and we have to calculate each year what will work for us and which regime to choose. Calculation has to be done by us every year, right? And if we do calculation and we understand, like for example, we created a case here. What was the case? 7,50,000 earning, low saving, high saving case, right? That is what we did. We could clearly see, now if we take up the same case and tomorrow if employees come to us and they say, I don't know what to choose from, I have no clarity, and we are just able to detail this case across to them, then we have done our job as HRs. As well as this understanding allows us to calculate our taxation for one particular year, right? Is it clear? Very, very important. So that's a very interesting question, Akanksha. Actually, it's a very, very good question. In fact, it's not out of context. Uh, what she has asked is, companies, can they choose on behalf of employees? I think companies, this has never happened before in Indian history, right? So it's difficult to gauge or predict how would companies respond to this, right? Because all this while, the choice was with there was only one choice. There was no choice, in fact, right? So companies would ask for your investment details, etc. If you have provided them, they will calculate accordingly. If you have not provided them, then they will go ahead and then they would calculate tax with whatever data that they have available. But now they have two choices. So basically, it is a compensation benefit nightmare that HR departments are going to face from next financial year. It also means more vacancies in compensation and payroll department, because now you would need more people because there would be increased workload, right? So it would also mean that. But as far as I understand of what can happen, what are the possible scenarios, are that if somebody is not changing anything, if they are not opting for a new scheme, companies would stick to calculating their uh, uh, income tax as per the old regime. Only if somebody opts for the new regime and makes a HR department aware that go ahead and do it for me, that's when they will do it. So they will stick to whatever has been happening with the existing employees. This is my assumption again. Some companies may go about doing some workshops on making people more aware, and some companies may write a mail and say, which one do you choose? Etc., etc., etc. But most of it would be sticking to the old regime for people who have not asked for the new regime, and only people who ask for new regime, only that needs to be taken care of, right? So you don't have to use new regime compulsory, as I said. You have a choice between old and new regime. Whichever works for you the best, as I showed in the case one and case two, you have to go about calculating your own tax and also guide maybe employees in terms of what would work for them, and then choose what would work and what would not work. Vehicle loan has some different logic that comes across. Vehicle loan cannot be claimed under tax exemption. For proprietors who are running companies, there is a possibility of claiming expense and reduction in income tax, but that's a different topic altogether. We are talking about HRs and employees and salaries. All this, people who do CHRMP certifications, so this is just a webinar briefing on income tax. When you talk about it linking to salary, you first learn how to calculate salary. So you learn compensation benefit planning, you learn how salary slabs are created, you learn how competency structures get computed in terms of creating that 5 to 8 lakh salary slab for, let's say, a senior software engineer, and why it is 5 to 8 lakhs, why not 4 to 6 lakhs. All that needs to be understood. You understand concepts like internal equity, external equity, individual equity, you understand median, all that goes into planning. You also understand how reduction in compensation turnover takes place. Then you get into understanding statutory compliances, you get into understanding basic HRA, DA, PF, ESI, LTA, LTC, PTIT. You learn gross type CTCs, type 1, type 2 CTCs, etc. All that you learn when you do a CHRMP certification, and then you learn income leave calculation, then you learn income tax calculation, and on that income tax calculation, you learn how to calculate net salary after tax. This entire is part of CHRMP curriculum. A small part of it is what we have presented today. But if you're interested in learning the whole thing, I would say that you can opt for going ahead with the CHRMP certification. People who drop their email IDs who are interested can just type in their email IDs in the column here, and I would have my team get back to them with special offers. Anybody who's attending webinar has a special offer with the voucher code that would reduce the current pricing for CHRMP for them. So you can probably type your email IDs across if you're interested in not only knowing Comp and Ben, but the entire HR in its entirety. Or also only Comp and Ben. If you are interested in that, you can probably go about dropping that across, because this would really help. This is just a part of what we have tried showing, but we have less time. I mean, we have already overshot time by about 40 minutes. It was a 1-hour webinar, but we are talking about 60 to 80 hours of pure content if you're attending CHRMP. So there would be a lot more of value that you would go about seeing here, right? So basically you will have, so this is how you go about calculating. So 3 things that I wanted again to stress on. Any questions so far? And any additional questions that you have? Yes, Akanksha, I think there is a huge task, and there is happiness, and there is coolness, and all that is involved here, because this is actually, in a way, it's good news, because you would need 1.5 times the CNB executives that you needed earlier. There is no doubt about that, right? And it would need more awareness, and there would be a lot more questions, a lot more queries that would come from January till March that you have to go about handling from a perspective of a CNB guy. Yes, it would be quite challenging in times to come. Okay, one more question Praveen, I think, has asked is, has no or less savings, is not aware of new regime. What as HRs are we? So if there is no saving or less saving, standard deduction any which way would apply, PF would any which way apply. So then the calculation will become much more simpler. If the person is of high salary slab, like somebody's earning 12 lakh, 15 lakh, 16 lakh, 18 lakh, and he has no savings, you can simply tell them to go for the new tax slab. You can simply tell them, because if the person has less saving or no savings, then the new tax slab is preferable. Only in case of persons having claiming for home loan exemptions, child education fee exemption under ATC, ATD, etc., 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 is when you have to really go about calculating of what would work more better. That's also true, right? Okay, any more questions before I move to the, I just probably put everything together of what we have done and talk about it more. Any doubts, any questions? You would want me to repeat anything? So, the TDS, which is rate of taxation has changed. Rate of taxation in the old regime was 5%, 20%, 30%, right? In the new regime, the rate of taxation is 5%, 10%, 15%, 20%, 25%, and 30%, with a gap of 2.5 lakh each. So in old regime, it was 2.5 to 5 lakh was 5%, and 5 to 10 was 20, and above 5 to 10 lakh was 20, and above 10 lakh was 30. Now it is 2.5 to 5%, 5 to 7.5, 10%, 7.5 to 10, 15%, 10 to 12.5, 20%, 12.5 to 15, 25%, and above 15 lakh, 30%. So rate of taxation, or TDS, what you call, has changed in the new regime. Yes. It's reduced with more number of slabs, but without exemptions. Guys, any more questions? So EPF rates keeps on changing year on year, and lately 1st of April or end of March is something that we get to know more of details. As far as I know, it's 8.65% currently for PF rates. This may change. It may go up or go down. All likelihood, the trend we have seen in last 2 years is that it's going down, the PF interest rate. PF interest rate is mandatory. Yes, you have to. So in PF, there are three contributors. One is employer, one is employee, and third is the PF department, which gives interest on it based on the interest rate. So yes, that is mandatory. So guys, what we have discussed today is this whole interesting concept of what has happened in Indian taxation industry by the new budget 2021. I think it's very interesting and challenging, and I think as HRs and as compensation benefit executives and also as individuals, it's important that we keep our eyes and ears open in terms of what's happening. It amounts to relearning and unlearning and again relearning a lot of new things. What we have discussed today again is something that I would rush you guys through, and that may help you with thinking of any more questions that you might have. I think this webinar was brought to you by CHRMP. CHRMP stands for Certified Human Resource Management Professional. We talked about structures. We started with understanding income tax, where we understood direct and indirect taxes. We understood that income tax is a direct tax. We understood that TDS, TCS, and voluntary payment in form of self-assessment and advance tax is possible. We understood HUF, body of individuals, local authority, corporate firms, association of persons, etc., of who pays those taxes. We understood that income tax primarily is paid in three categories of people: less than 60 years, 60 to 80 years as senior citizens, and 80 and above as super senior citizens. We understood the income tax slab. There was an existing or old slab that we talked about, and a new slab which is applicable for coming financial year. We understood that the rates are 5%, 20, and 30% based on earnings for the old slab. And we also understood 87A, which allows an exemption for people whose earning or net taxable income is below 5 lakhs, where you don't have to pay any tax. We also understood rate of taxation for senior citizens and super senior citizens, and a comparative table that allowed us to put all of this understanding together. We moved to the new tax slabs, where we understood that now there are much more number of tax slabs with reduced rate of taxation, and that all the tax that we do, what gets added is a 4% health and education cess. We also understood tax on rich. Now, some of it is important because if you look at salaries these days, people do get salaries of 60 lakhs, 80 lakhs, crore, etc. Right? So knowing this is important, because apart from the income tax, you pay a 10% surcharge of that income tax amount. Just how health and education cess is calculated, the same way surcharge is also calculated. So 50 to 1 crore, there is 10%, then it is 15% from 1 to 2 crore, 25% from 2 to 5 crore, and 37% from income exceeding 5 crore, plus 4% health and education cess also applies. We understood the role of exemption. We understood that in old regime it is as it is, exemptions are applicable. In new regime, majority of exemptions are not applicable. We understood that the most claimed exemptions like standard deduction, HRA, LTA, professional tax, IT section 80C, 80D, 80E, 80EE, and allowances like child education allowance or other special allowances are not allowed under the new regime. It is all allowed in the old regime. Food coupons may or may not be allowed. Some of what you would read, they would say that it's allowed, and some of what you would read would say it's not allowed. So that clarity is not there. That clarity has not been mentioned out in the budget document. New regime does allow few exemptions like interest on rented out property and for first time house buyers in terms of interest amount. Uh, uh, Also, if somebody is contributing in the national pension fund, that gets allowed, and other generic things like at time of retirement or of gratuity or interest on PF or leave encashment or VRS, all this is still allowed under the new regime. We took an example where took a case one of less savings under old regime. We saw that we were paying about 5,200 rupees more than the new regime, right? In the calculation that we did in here. And the same calculation when we did with more savings, savings of about 1 lakh under IT section 80C, where net taxable income became 6 lakh for somebody earning 7.5 lakh, we saw that there was considerable drop in taxes, right? Where we were able to now save the exact amount, which is 5,200 from the new regime. So what it calls for? It calls for us being planning our investment savings in advance. It calls for us having awareness. It calls for us calculating each year and then choosing which tax slab or which tax regime to go for. Kindly note, as salaried employees, we have freedom to move from one structure to other structure n number of times. So if this year's old regime is suiting me, I'll go for it. If next year new regime is suiting me, I'll go for the new regime. If year after that old regime suits me, I can shift back to old regime. But as businessmen, as proprietors, as individual taxpayers, I can make that movement only once, which means if I move from old regime to new regime, I will not be able to come back to the old regime again, right? Uh, Now, a brief about what we have done. So, CHRMP is a 13-year-old certification. There have been more than 7,000 certifications from 41 nationalities who have taken. You have sent us in Bangalore, Chennai, Hyderabad, Mumbai, and Gurgaon. And abroad, we are in Dhaka, Bhutan, KL, Singapore, Dubai, and California. We have CHRP is a global certification body because the certification partner is Pearson VUE. You can take these certifications both in self-paced format where you can learn from your home and then write the certification exam and validate your skills in the nearest Pearson center close to your house. Also, you can, in the learning centers that are in India, you can do the certification through learning from instructor-led training where trainers would be taking you through. That is also something that you can go about doing. Anybody who's leaving their email IDs here in the webinar would get a response from our consulting team, and special offers for people who attend this webinar would be made. This is partial list of clients that we have, and that goes about ending the session or the webinar for today. Any questions, guys? Anything that you would like to ask? Sodexo passes are nothing but coupons, food coupons, and that's what I said, that Sodexo coupons or food coupons, that clarity is still missing. Any other questions? Thank you so much for being part of this webinar. I would thank everybody for their time and extended time. Almost 2 hours this webinar went. And we have informative webinars happening every Wednesday. We would love if you could recommend more people to attend these webinars. We would want more and more people to join, and we would like to help them in knowledge creation and understanding of various concepts related with human resource management. Thank you so much, everybody.